Markets reward good governance. Markets reward companies which do things for the long run. Markets reward companies which are focused in terms of delivering show. If the trade agreements happen, if this tariff issue gets sorted out, especially between China and US, sense as the uncertainty reduces. I think what matters for the fixed income markets going forward is going to be how much supply is going to come through.
Hello and welcome everyone. Today we have a special podcast on our anniversary edition with HDFC Life. As you all know, within HDFC Group there are two companies who have completed 25 years of servicing to the clients. It's HDFC Securities and HDFC Life Insurance. And our today's guest is from HDFC Life, the CIO of HDFC Life Insurance, Mr. Prasun Gajri. With over 30 years of experience and a stable track record, we are privileged to have him with us. So welcome, Prasun. With 25 years completion of HDFC Life, and you have spent a great amount of time with this organization. So your views on HDFC Life Insurance?
Oh, it has been a fantastic journey. I think from where we were to where we have come, it's a long list of things which as a company we have achieved, and thanks to the HDFC brand name and association, I think everyone associates HDFC Life with one of the preferred life insurance providers who can be trusted and who is up there for the long run. And we offer obviously a multitude of products which you are all well aware of. So I have also had a long journey with HDFC Life. So really proud of the same and look forward to many more.
Being a CIO of one of the top private insurance companies of the country, I mean, how does it feel managing a team of 7 fund managers and another 20 research analysts and credit analysts? I mean, how is a day for you? When you walk into your office or cabin, what is the motivation or belief with which you start your day?
Every day is it's wonderful to get into office on that count. See, as you're well aware, and anyone who's associated with the markets never have a dull day. They provide all the excitement you need in life, and then we have seen so many things happen just over the last 5 years. From the pandemic to wars to tariff to changes in terms of monetary policy across the world. So it's every day is something new. Some regulatory change will happen. So you have something on the plate, something to think about, and that is what excites us. Now, as far as managing a large AUM is concerned, I think it's no different from managing a small AUM in some manners. I think as a large institution, the focus is on setting up good processes. So whether you're managing 1,000 rupees or whether you're managing 1 lakh crore, if you have the good processes, which everyone follows, by and large, the job of the CIO is done. So I think that is what we try and focus on. Institute those good processes pretty much across the board. Make sure we monitor them, make sure we keep a check on that. And at any point of time, keep measuring what we are doing. I think that is what the gist of it is all. And that is something which has worked for us very well over the last so many years. And we believe with the same methodology, same processes, we can continue to grow our AUM multifold from here and continue to do pretty well with these processes.
Great. So within our group, I mean, all our group companies are known for their strong compliance and ethical practices. But as a fund manager, to deliver return in a very ethical environment, I understand it's a challenging job because you have limitation in terms of what you can buy and what freedom you can give to your team. So in such an environment, how do you still continue to give better returns and uplifting the performance of all your schemes?
I disagree with the very fact that being focused in terms of processes, ethics, governance, and returns are dissociated. I think over the longer run, we have seen markets reward good governance. Markets reward companies which do things for the long run. Markets reward companies which are focused in terms of delivering shareholder returns. So as a fund manager and CIO, if we continue to focus on investing in such companies, we believe over the long run, the returns will come. There always going to be phases where markets kind of deviate from that path in the short run, but never in the long run. So I don't see a dichotomy between following processes, focusing on governance, focusing on quality of the stocks you're investing in, and we believe the returns don't get compromised by that. You'll always have those 3-6 month phases here and there, but broadly, if you look at the performance of our funds over the longer run, it has stacked up pretty well, both against our peers and against the benchmarks. So therefore, I don't see any dichotomy between trying to follow good processes, trying to invest in good quality companies, and yet making good returns. I think it's not just us. I think a lot of large institutions follow a similar process, and I don't see a challenge with that. And being HDFC, I think it's imperative that we focus on things like that.
So, as you know, we are into stock broking, and our clients understands equity very well. But one question what we get from our client is, how is LI life insurance investment different from mutual fund investments? Many a times they feel that mutual fund investments are much more visible and in terms of the publication or the awareness that is there. At the same time, life insurance investment plans are not that much publicized. So how is it any different or is it same in comparison to mutual fund?
Okay, let me take it up in a slightly elaborate manner actually. See, as a life insurance company, we offer lots of different choices from a customer's perspective. Obviously, there is pure term which has no element of investment in it, but if you just park that aside for the time being, there are a lot of different products which have an element of investment related to them. And for broad classification, and that is what the normal market way of regulatory way of calling them, we have what we call non-participating, participating, and ULIPs. Now let me kind of break this jargon in very simple terms. ULIPs we pretty much understand. ULIPs are basically standalone funds with specified objectives, and the customer chooses which funds to invest in under a specific ULIP plan. These funds, we offer funds from pure equity to pure fixed income to hybrids. Within equity, we have funds which are pretty large cap oriented. We have funds which are mid cap oriented, which are funds which are kind of a mix of both. So we pretty much offer the entire range. And similarly on the fixed income side, these funds have daily NAV. The portfolios are disclosed. There's a monthly fact sheet. So they are as transparent as a mutual fund would be in terms of where they are invested in. So there is no real difference between mutual funds and ULIPs are. Now, in terms of how ULIPs are managed, again, there is no difference. It's just that our customers could have a different perspective vis-a-vis as a mutual fund customer. As an insurance company, we may look at risk differently from what, say, a mutual fund looks at. But I can't really comment on other insurers, but I can comment on HDFC Life, whereby we may be a little bit more conservative in terms of looking at risk, how we take risk, how we kind of deviate from benchmark vis-a-vis some of the other funds. But end of the day, intention is to give decent performance over the longer period of time, both against the benchmarks and the peers. So I think we have managed to achieve that in most of our funds. So that doesn't really make any major difference between where ULIP would be managed or mutual fund would be managed. Now come the other two parts, the funds, so participating and the non-participating. So non-participating, let me just, it is very simple. You know about, everyone in the market knows about Sanchay Plus.
Yes.
Right. So it's a fund where you basically guarantee the outcome. And there are varying ways in which the outcome can come to you. You can get cash back upfront, you can get cash back in a few years' time, you can get a lump sum at the end of it. So basically there's money in and money out. But whenever the money comes out, so you pay for a specified period, you get money for a specified period. But whatever outcomes you get are guaranteed upfront. Now, and that was a big change in the market because there is absolutely no institution in the market apart from life insurers who can give this long-term guarantees which are inbuilt. So that remains a category, I think very popular category within the market space. Then comes probably which is the least understood of it, which is the participating part. Now participating, as you would know, is something which LIC used to be the dominant player back when the private sector did not exist. So this has been something which the Indian investors have known over a long period of time. So basically, when people say bonuses from insurers, etc., it's all linked to participating. So what does participating say? So participating is, in a way, easier way to understand it is a mix of some guarantees and some variable returns. So what happens is, so the money is pulled in, it gets invested. Every year, the insurance company will declare some reversionary bonus. Now that bonus basically accrues to the policyholder, may not get paid out, but accrues to the policyholder. And once it is declared, it becomes a guarantee for the policyholder, right? And every year that continues. So based on, and then there is something called a terminal bonus, which is the variable piece, which will come at the end of the policy. Now, the way we really look at investing this is to do a mix of fixed income and equity. Where fixed income is going to largely back what the guaranteed portions are. And equity is going to provide the variable return in the end. So that is the way it is. So depending on the way construct of the underlying participating plan, you could have equity ranging from say 20, 25% to even 40% under the various different kind of plans. So this is a product which allows a customer to invest for the long term with some sort of a guarantee inbuilt based on the business. So it's a bit of a hybrid between say pure equity ULIP product and a non-participating by the nature of it given guarantees is largely backed by fixed income instruments. But there, whatever return comes, even if you don't earn it, we are still guaranteeing it. In participating, the way it works is the largest part, 90% of the surplus which accrues in the fund gets passed to the policyholders, 10% goes back to the shareholders. So that is the way it works. So this is something which over the longer period of time can give good risk-adjusted and tax-adjusted returns from a customer perspective. So I think long answer, but broadly, hopefully sums it up for everyone listening.
No, sure. As I said, this is an informative session. So even if the length of the answer is long, but if it makes sense, that is why we are here. So thank you for that long answer. Now, it will be unfair on my part if I will not ask the questions on gold and silver. Because being a CIO, I'm sure you would have got many questions that gold and silver, where is it heading? So was it the greed or was it the lot of buying by the central banks that led to this spurt in gold and silver prices, and what is the future outcome?
Okay, let me first make a simple disclaimer. As an insurance company, we do not and cannot by regulation invest in commodities. So we have no exposure to gold or silver.
Right.
So therefore, there is really no official view as a company we have of it. Now I can share what my personal thoughts on this are. So I think it's always whenever in any asset rises, there is always a combination of fundamental factors and factors which you may call greed or the desire of the investor to get it. Obviously, we all know gold does well in uncertain situations, and we have seen this uncertainty only rise over the last few years.
Right.
And gold has done very well during that period. Now, uncertainty has come from various sources and has increasingly been driven by the overall tariff policy which is US is trying to drive, where people are really not sure how the fiat currencies are going to behave, with how much depreciation can happen, and therefore people are looking for assets which will preserve their value during this phase. And obviously, the larger part of the buying has been led by central banks because some of the central banks have been trying to wean themselves away from fiat currencies, especially US dollar. And that transition has meant that the alternative assets for them has been gold. And that has obviously driven gold. And silver has been more of a byproduct, whereby seeing gold run up, silver has kind of followed suit and in fact done better than gold over the last, the years. Now, where does it all stop? Hard to say. We have seen another cycle like this when the oil prices happened, where gold really rallied massively in the 70s. This rally is still not as big as the rally which we saw at that point of time. So from that perspective, can there be more to come? Maybe, maybe not. It's very hard to predict. I think it all boils down to what kind of uncertainty prevails in the market. If, for example, there is a settlement of the tariff issue one way or the other, whereby US and China decide to figure out a more amicable way to settle their differences. Countries like India and Brazil get a fair deal in terms of final tariffs. And this entire noise on this dies down. The uncertainty tends to recede. And if that happens, I'm pretty sure gold will stop this massive rally. If that doesn't happen and situation gets aggravated, one would hazard a guess that this rally to some extent can continue. Obviously, to what extent will central banks keep buying? Hard to say. Nobody knew they were going to buy this kind of numbers. Whether it's really going to be possible for them to continue to do it. So I would be a little bit wary in terms of, as a retail investor perspective, to catch the fag end of this rally at this juncture. What I would urge investors to do is keep a watch in terms of how the global macro is developing and if this uncertainty is seen. If you look over the last 10 days or 15 days, we have seen some sort of a pullback in both gold and silver. And that has been driven exactly by the same uncertainty getting lower. We have seen some sort of a rapprochement between US and China, whereby some conciliatory statements have been made, and things are looking brighter on that perspective. We have seen some positive view in terms of India-US agreement also getting, obviously we keep getting news to the contrary as well, but the probability of something coming through is better than what it was, say, 6 months back or 3 months back. So, if this uncertainty recedes, our view is that, but my personal view is that gold will kind of take a breather. So, and if you look at the last 50 years of gold returns have come in very small periods, and after that, gold tends to just stay stable or negative for a small period of time.
So basically, we all know that life insurance portfolios are meant to be built for a longer time horizon. So, what is your approach while building a diversified fund? Will it have more of large cap, more of good promoter-backed companies? So, how do you plan for a good portfolio now? And what is the investment window? Is it like 10 or 15 years, or it could be even 5 years for a particular stock coin?
Okay, so you see, on our ULIP side, we manage different kind of. So we manage large cap, we manage mid cap, we manage mix of both. So depending on the objective of the fund, we choose our stocks. So while in our conventional books, for example, in our participating books, the focus is a little bit more towards large cap. I mean, let's be fair on that. How do we construct a portfolio? Frankly, not very differently in any of the asset classes, whether it's mid cap or large cap. I think it's a combination of 2-3 things. One is follow a certain process around terms of building the portfolio. Every institution would have that. We have our own processes in terms of how would we take risk, how much risk we'll take in a particular fund. And when I say risk, it could mean different things. It could mean how much deviation we'll have from the benchmark, how many stocks we'll hold in the portfolio, individual stocks, what kind of exposure are we willing to take, what is the governance standard, etc. of the company which we would want to include in our portfolios. All those factors come into play, and we have a very well-defined process around this. So that is one. Obviously, there is some element of top-down, whereby you look at the macro, you look at the bigger picture and say which way the markets are headed. But the larger part of the portfolio construction is more bottoms-up, whereby you look at individual stocks. And at any point of time, you want to build a portfolio which should do well over the next 2 to 3 years at least. We never take a call based on something going to happen over the next 1 month, 2 months, 3 months. It doesn't work for 2 reasons. One, we are reasonably big in terms of AUM, so it's very difficult to really build it. And as conceptually, we believe that when our customers are taking equity exposure, they're taking it for the long run. Because insurance is a long-term product.
Right.
They're not here to maximize their profits for the next 3 months. So why should I kind of align my portfolio to that? I think these are some of the broad rules. So we have very well-defined rules in terms of what calls fund manager will take, what is the role of the analyst in the entire system, what role I will play in the entire fund management. So, and we believe that irrespective of where the markets are, processes are very important. And as long as you keep following your inputs, the outputs eventually take care of themselves. Otherwise, it's always uncertain in terms of how the funds will perform. So as long as we believe we're doing the right things, we believe the performance will take care of itself. The performance is not coming, we evaluate both our inputs as well as if something wrong has happened or something, the portfolio construct needs to be changed. But by and large, we believe the processes help us do well within that.
What will be average holding of stocks in any portfolio?
I don't have data in terms of how much asset turnover other people will have, but we are not the brokers tested. That's very clear. Our asset portfolio turnover is low. And the intention behind that is not deliberately to keep it low. It's just the way we construct our portfolios and hold it. What makes us sell? See, one bad news is not going to make me sell a company.
Sure.
So unless it's something very fundamental to the company. So therefore, we are willing to kind of wait for the stock to compound. So as an individual and as an institution, I think we like longer term compounders rather than short term flips. So I think that is the broad pieces of it. Obviously, any portfolio will have a little bit of element of everything, but the larger part of the portfolio is going to be looking at something we can compound with the long.
And the number of stocks in a portfolio?
So we do not run very concentrated portfolios. Now, why we do that is I think we have a certain view on how much risk we want to take, and based on that we run a reasonably well diversified portfolio. So most of our funds will have say 80, 85 stocks. Some larger mid-cap funds with larger AUM can even have 100 stocks. So we're not running this 30, 40, 50 stock portfolios. So not a very large concentration.
In a volatile market, how do you decide what will be your cash component and what is your current situation in terms of the cash reserve that you would be holding for a better opportunity to come in and then deploy?
See, when you see, we are not very big believers in holding cash. Cash is a double-edged sword. It can do very well for you if you get it right, but can be horrible for you if you get it. We believe that if we are managing for the longer run, some amount of cash is imperative, but taking active cash calls doesn't really help. Now, there are always going to be exceptions to the rule. There can be some market turnings which you are very, very kind of confident about, at which point of time you may want to raise cash a little bit. But I frankly don't recall our cash ever going to double digits or even going beyond 5 to 7%. So we are not really the investors who take active cash calls to manage portfolio returns. We believe we are better off invested in good quality companies through thick and thin. And over the longer term, that works out much better for us rather than taking short-term calls with cash. Because when I take calls with cash, I have to get my market timing right every time. And one time you get it wrong, it can wipe out all the gains from holding cash in the previous 3 times. And we've seen this. I mean, when the markets turn, it tends to be... I still remember 2009. A lot of people were holding a lot of cash prior to the election results come, and there we are. So anyone holding cash benefited for probably a year. In one day, that all got wiped out. So enough instances of this kind. So we are not very big believers in cash.
There's one section of market which feels with the kind of Indian markets has seen growth. Valuation, even though they are an important parameter, but they doesn't matter in terms of the selection of the stocks, because even with a higher PE, there is a possibility that you could have a stock which still has a multi-bagger opportunities. What is your view on this?
I think valuations are always important, will always remain important. If you believe valuations are not important for equity investing, I think we are doing a disservice to the profession. Can a high PE stock still be a multi-bagger? Yes, it can. I see P's can be looked at in different ways. So why would a high PE stock still be worth investing? And if you believe and if you're very confident about the earning growth coming through, then high PE can be justified. But then you have to be very clear how long this earning growth can continue. As a fund manager, you have to have a very definitive view in terms of why you believe that is likely to happen. Because problem with these kind of stocks always is you get 1 quarter, 2 quarters of this earning, those elevated earning expectations not coming through, and the stock takes a big pounding and the liquidity in that stock goes for a toss. So then you're stuck with that, and we have seen enough examples across various funds. We have also might have faced some challenge in 1 or 2 stocks here and there on discount. So therefore valuations are always important. But that does not necessarily mean that every stock with low PE is a buy and every stock with high PE. So you have to be very, very clear in terms of what is that you are playing for, what is your earning expectation, why you believe that is going to be delivered or not delivered, and then like. So it's not a simple answer in that respect.
So with 30 years of market experience, I'm sure you would have seen different market cycles. But my next question is very specific in terms of the promoters. Now, if you see the last 10 years, India has become a major hub for the startups, and we have good number of young entrepreneurs who have come and got their company listed. Do you see any mindset change or the approach business has been considered by a new age entrepreneur compared to the old promoters who have built a fairly big name and status for themselves and are stable, but their future may look bleak looking at the competition or the innovation and at the pace at which it is happening?
I don't think new age or old age matters. I think we have always had very good and passionate promoters to promoters who are here for the short run, who are trying to not build the business from an investor's point of view. So I think both kind of promoters existed earlier, both kind of promoters exist today. So you have to have a judgment call on the promoter, how passionate the promoter is to building business for the long run, what skin in the game the promoter has. I mean, a lot of times in newer age companies, you find promoter has very limited ownership left, and therefore it makes you think through whether the promoter has really any interest in building up the business going forward, or is he happy kind of sitting on the wealth he has already created from the business. So I think those are calls you need to take on promoters. I think it will be wrong to really classify them as old age or new age. Each promoter is different. But having said that, you are seeing a lot more first generation entrepreneurs who have come through, extremely passionate, extremely hardworking, who have built some great businesses. I think that's great for the market. So, and also I think promoters have also realized in some manner that it is, if they behave from a longer term investor's perspective, create businesses in the long run, market is very rewarded. And a lot of promoters, I think, recognize that. And that I think is very positive, because the interests that can align for minority investors like us and the promoters, whereby both of them are trying to create wealth for the long.
Out of the overall book that you manage, I believe that's 3 lakh plus crore. What component of that would be into fixed income?
So roughly we have over 3.5 lakh crores. So broad is that 1/3 is largely in equities, and 2/3 is in fixed income and other assets. Other assets are small, so largely fixed income. Fixed income has both elements of government securities and corporate bonds.
And with GSEC yield of about 6.35 and the current inflation, and we are expecting a rate cut maybe next 2 quarters. So where do you see the fixed income market moving forward?
So fixed income markets, I think three things. I think factors which are at play, obviously inflation, as a rate cut cycle. So rate cut cycle is by and large through. You may still get a rate cut, but the larger part of the rate cut cycle is done. I think what matters for the fixed income markets going forward is going to be how much supply is going to come through. So how much the government is really going to come to the market for. I think that is the most critical part of how the yield curve will behave, and which part of the curve government comes and borrows it. So if you think about the next 1 or 2 years, I think the challenge which we fixed income market faces is the fact that we are looking at a phase where the nominal GDP growth is more towards single digits. Now, if you look at it, that means and tax collections are more linked to the nominal GDP growth. Our real GDP growth may still remain, say, 6.5% or so, but with the deflator where it is, your nominal GDP growth can continue in single digits, which means your tax collections also may continue to be in single digits. And if the government wants to continue to, and we have done a lot of fiscal stimulus whereby the GST rates have been cut, tax rates have been cut, so that puts a little bit of pressure on government revenues going forward. Put all this together, one would believe that the borrowing program of the government will continue to be reasonably large. And how that pans out, are there any alternative ways? Will the growth pick up? I think those are the factors fixed income market will watch. For the short run, yes, market is expecting a rate cut. The yields can come up from current levels a little bit. But beyond that, I think we'll remain in a stable way, depending on how the global macro pans out and how the demand supply situation in the market.
And if my understanding goes right, I believe fixed income market is highly dependent on the GSEC supply or the kind of overall cash management happens. Do you still feel there is a big scope for corporate bond or private players to come in? Because not enough corporates are there in AAA or E plus category, where life insurance company can invest for a longer period of time, and that is why this skewness towards GSEC.
See, corporate bond market in India has been. We've always been talking about the corporate bond market becoming bigger and bigger in India. Now, there are various factors. I don't think we can get into it here. But I think I do see more and better activity in the corporate bond market in the years to come. I think it's a requirement both from our point of view, I think from a borrower's point of view. We are starting to see a lot of action in the private credit side now, with a lot of AIFs coming into play. hopefully the markets will expand further, where people will come out and borrow in the market rather than just going to the banks. That will help. But as of now, I think liquidity is still limited, except in the larger AAA issuers, and therefore our allocation also tends to be biased towards the larger AAA issuers. But yeah, it will be interest of everyone, including ours, if this market becomes bigger and better and more liquid with larger issuers across the category from AAA to triple D, maybe that will help.
And what will be your sense in terms of the credit evaluation parameters that were existing, say, about 20 years back and compared to what it is now? Because there is a lot of data flow which is available. So, just to give you an example, for example, a company may be higher on debt, but you have a better visibility in terms of its growth, the supply chain, on the overall cash flow. So, you might get little liberal in terms of still going for an A minus or an A category of paper, considering it is a low rated corporate bond, but I have better visibility and confidence in the company.
Look, I don't think the fundamentals of credit has changed. I began my career in credit. So there is really nothing which has changed since then in terms of credit. All you are evaluating is the willingness of the borrower to pay and the ability of the borrower to pay. I think how you judge that might change a little bit here and there, but fundamentally doesn't change. All you're evaluating is what kind of cash flows the companies likely to generate and what is the likely cash flows which they have to pay out. Now, if there is more information available which helps to evaluate those cash flows better, that always helps. I think what matters in terms of credit investments is the credit priced correct. Right? So it's not just a question of evaluating the credit. You evaluate the credit, you believe there is a certain element of risk. Are you getting paid for that risk? Today, we believe in the corporate bond market in India, it's not necessarily that way. A lot of time, credit is not priced accurately in our view, and therefore that keeps you away, especially from low rated credits. And obviously the liquidity angle. So let's see how it evolves, but we are hopeful and we are seeing some signs of better activity in the market, especially with more and more players in the market.
So we have heard a lot about the markets and how HDFC Life approaches the fund management and manages the client's money. Now let me understand how does Prasun Gajri manage his day-to-day life. So what's your weekend like? Are you still into the economic times or the business channels, or you're different on weekends? Mix.
No, one has to take a break from the market. So I am not the guy who's wedded to the markets on weekends. So I'm like any other normal person here with family. Both my kids are in college, so me and my wife, and yeah, do the usual activities here. You try and kind of get some exercise going on weekends, which you don't end up getting on weekdays. I like to read a bit on various topics, not necessarily in economics and markets. Obviously, you watch your fair share of OTT, and that's what it is. And try and go and either watch a movie or go to eat. Yeah, and that's a typical weekend for most people, and I am no different.
If you read any of your favorite books, or if you follow some leader, maybe from the market or from anywhere else, who is that person? So, choice between a book or a person that you admire and you follow.
Well, lots of books. I mean, I am a big reader in terms of both fiction, non-fiction. At any point of time, there are 2-3 books which I am kind of in the middle of. I can get bored with one and start the other, but then come back to the first one. So I think it's not that there is one book which kind of gives you that aha moment. The reason I think I prefer books at any point of time is that just opens your perspective on various things. If you read about science, it gives you a different perspective. If you read about history, it gives you a different perspective. Obviously, you read about economics, history of economics, it gives you a different perspective. So it's that which really. Otherwise, as far as people are concerned, I am a big sports follower. So I'm a big admirer of some of the sports people across sports who really inspire, and I really admire the way they have carried themselves. Obviously, cricket remains a big part of that, but apart from that, across football, badminton, tennis, you have your favorites and you follow them, and you admire the work ethics and the brilliance they bring to the force. So I think that's an inspiration, for example.
One key learning from the market, it could be from your mistake or something that you missed.
I think one key learning is, boss, it's never different. Markets are pretty much the same. What matters of the longer run is not the market, but your discipline in terms of how you conduct yourself in the market. Easier said than done. Everyone in hindsight, it's very easy to say, I should have bought at that time, I should have sold at that time. But when you're in the midst of it, I think emotions get the better of you. Your judgment gets clouded. I think the experience only tells you that you need to be kind of focused more in terms of the discipline rather than getting straight by that. I think that is one big learning which I have had over the last 25, 30 years. The other learning is you have to evolve and adapt. As a fund manager, what you were doing when you were managing 1,000 crores to when you are managing, say, a 25,000 crore fund, you can't do the same things. You cannot have the same style. You have to evolve. You have to figure out what works under various circumstances. Markets change. There will be times when same stock was considered expensive at 25p and the same stock is considered cheap at 40p each way. Why is that? As a fund manager, are you willing to evolve and consider that? I think those are some of the learnings. So if there is anyone who is really getting to managing money, first thing, discipline and processes. Sounds easy, very difficult to do. And second is your own evolution as you grow bigger. I think that these are two things which have been learnings across this space.
Great. There would be days during your market cycle and the market is not doing good. There's nothing much to do in terms of deployment. So during such time, how do you interact with your team? Do you use it as a break of time or you gather to
there is always every time when markets are not investable. So there is, in fact, markets become more investable when they fall, right? So I think it's important. So we as an insurance company, we have money flowing in every day across various product categories, various funds, which has to be deployed. Now, where do we deploy that is obviously the question every day people have to ask themselves. So, and we believe that as long as you have a well-defined process to construct your portfolios, allocate across the asset classes, it's a fairly easy job once you have decided that. But I think what you need to do is in fund management, in investment, I think the biggest thing you can do and the biggest favor one can do to oneself is to be in a constant review mode. Never be believe you have got everything right. Never be so sure of yourself. Question yourself every day whether what you're doing is right or wrong. Never get wedded to what you think. Again, as I said, this is all theory. It's very hard to put this into practice, but you learn along the way. So I think these are some of the things. So even if the markets are not going anywhere, there are a lot of things to do, which as a fund manager or the CIO, you need to be cognizant of.
Balance sheet or management commentary, what would you rely on?
Management commentaries are useful, but not necessarily. And different managements have different ways of giving commentary. So it's one single management commentary in isolation should not be looked at. I think you need to look at the management commentary, same management over a period of time, what they say, what they do, whether what they say happens, whether it does not happen, are they always too bullish, are they always too bearish? Only then can you evaluate the management commentary. So in isolation, management commentary has no meaning. Balance sheet is always important. So therefore, there is no denying that any numbers you look at, whether it's balance sheet, P&L, that will always take precedence over everything else. Management can keep saying what they want to, but if the balance sheet is telling you something else, that's where the truth is.
A good CEO or a good CFO, whom would you bet?
Both. I think it's important. So, see, you are buying the company when you are buying for the long run is to make sure that they get good performance in the short run, but they also have plans to grow the company of the longer run. And both CEO and CFO have a role to play in that. And some CEOs are far more involved in the day-to-day affairs. Some CFOs are more involved in the longer-term stuff. So it's hard to kind of break that apart. But what I would like to see in our company is what are they doing today and what are the plans for tomorrow, and are they coherent? Do they make sense? And does it really make sense to invest in a company which has such plans? I think that is important.
Okay. Sanchay Plus has been one of the path-breaking product launches from the house of HDFC Life, and with such a credible track record and the kind of faith customers have shown in this plan, I'm sure it is a big responsibility for you to commit for a very long time a good return. And in today's fixed income space, I do not think there are many products available. So, what is your plan for Sanchay Plus?
No, absolutely. A very important question. So, Sanchay Plus, as I earlier said, is a part of a non-participating. When you say non-participating plans, we are saying we are guaranteeing the outcomes to the customers. Now, once I've guaranteed it, that means even whatever I earn doesn't matter. I need to pay that much to the customer. So clearly, we have kind of taken an onus on ourselves to ensure that the money is managed in such a manner that both my policyholders as well as my shareholders are happy. Right. So therefore, there is a very, very well-defined process. As I keep coming back to the processes, I think there is a very clearly defined process in terms of how we will manage. So what is the underlying way typical Sanchay Plus kind of product would get managed? So you are getting, say, premiums for 5 years, say 5-year payment term, and then you have a gap of, say, another 7 years, and then you get paid a lump sum, just as an example.
Yeah.
Right. So what is that I'm doing today? So I am telling you, before even you give your first premium, I am guaranteeing you what I'm going to pay you at the end of that period. But I have a number of risks. I don't know how the interest rates are going to change over the next 3 months, leave alone next 6 years. Right. So I can't be sure about it. And I'm going to get your premiums not necessarily today, but over the next 5 years.
Right.
So therefore, I need to have appropriate processes and hedging mechanisms in place to ensure that I lock into the rate today for all the future premiums, and by and large also manage all the reinvestments which are going to come, because whatever I invest in also give me coupons in the middle to ensure that I earn more than what I am willing to give you. Only then my shareholder is going to be happy, right? And my balance sheet will improve. So therefore, we have a very well-defined process whereby investment team, our actuarial team, our finance team, our risk team all get involved in terms of either executing or monitoring the way these investments are handled, so that we are at any point of time absolutely sure that we are doing the right things to ensure this. So I think that is the way Sanchay Plus is managed. The assets are by and large fixed income, whereby we use government securities, some limited corporate bond exposure. We use various hedging instruments which are available from the market to ensure that we are hedged at the right time. We do not try and time our hedges. We do not try and say, okay, the hedging rates will be better in 3 months' time, I'll wait for it, etc. It's 100% risk management which we try and do on the day we need to do. So I think, again, coming back to the same discipline, same processes, don't get carried away. As long as we are doing the right things, we're absolutely sure we'll be able to deliver on the promises we have made our policyholders. So that is on Sanchay Plus, and that process has been well set for so many years now. And we believe we are very in good space there.
Yeah, that brings me to the last question of today's session. So you have a very powerful leader, your MD and CEO, Ms. Vibha Padalkar. So she has not only transitioned herself from CFO to CEO, but she has also taken HDFC Life to a new benchmark and to new heights. Your views on such a powerful leader being there at your organization and your experience?
Oh, absolutely wonderful. I've been, Vibha was the CFO when I joined the company. So at that point of time, I was not reporting to her. So I've been reporting to her ever since she has become the CEO. And it's been great working with her. She gives you all the space in terms of what you need to do. So I've never seen her interfering in terms of what investment should be. Having said that, she is very clear in terms of what the final outcomes should be, what the requirements for the business are. And she spends a lot of time in trying to figure out what are the focus areas for the company, not just in the short run, but for the longer term. When I say about a CEO, I want to see the CEO focusing on the longer term strategy, what the company could look like. I think she spends a fair bit of time on that, and that's absolutely wonderful. And at the same time, she can get very micro on areas which matter for the company in the short run, and she's as a complete pulse of the business. So she's a great combination of both the aspects. And at the same time, she gives everyone enough space to carry on their day-to-day work without being a micromanager. So I think a great combination. So I am absolutely happy being part of HDFC Life.
Great. Thank you so much, Prasun, coming today and sharing your thoughts on how life at HDFC Life Fund Management works and how you take care of the client's money. It was very important for us because we have a fairly large share of our clients' money into HDFC Life insurance plan. So we are grateful to have this session. With that, we conclude our today's session. I'm sure Prasun's view would have helped you in gathering a lot of information about how the funds are being managed at HDFC Life and the way your commitments are assured with HDFC Life team. As part of HDFC Securities product team, we do a lot of due diligence when it comes to recommendation of good product to our customers. And HDFC Life insurance plan are among the some of the top plans that we recommend. And we are proud to be associated with a company like HDFC Life. So I hope you all have a good time and be safe and keep investing in the right products. With that, I wrap up and conclude today's podcast. Thank you.